Next in radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. It's Kerry, Lutz. The date is January 26th. 2016, and bear markets, that's all anybody is talking about. Man, China took a huge hit this morning. The Dow was under 16,000. It's up a couple hundred points right now, but will it last? And Danielle Park, well, you've been saying for years now it wouldn't last, and welcome back, and here we are.
Hey, how are you, Kerry?
All right. So, doesn't look too promising out there, does it?
Well, it does if you're on the right side of the trades. It does if you're prepared for this downturn. It does if you've got liquid money set aside for buying opportunities down the road. You know, it's just that everyone is conditioned to think they have to stay with these things as prices plunge, or that they're locked in indefinitely to these unattractive valuations over the next decade. And none of that is true. It's just what you're being told by the mainstream financial types. Everyone's writing these sort of doom and dour articles talking about how yields are so low and return prospects are single digit as we look out over the next decade. And the only reason they're saying that, Kerry, is because they are fully invested today. And they are telling everyone that you can't try and protect yourself from the down cycle. So that's all very self-serving rhetoric of an industry who requires people to stay fully loaded in order to collect their fees. And that's why they are always counterproductive to what is in the best interests of the individuals.
Yeah, well, imagine that. Wall Street putting its own interest ahead of the people that they're sworn to serve and protect. Gee, I'm shocked.
Yeah, well, and I guess if there's so many things wrong with the models that people have taken in and sort of believed over the past 15 years. But this buy and hold, long always, stay with equities no matter what's happening, all the normal, all the usual suspects have been coming out in droves as this correction that's been going on for the past year. All the usual suspects have been coming out, particularly in the last couple of months, saying, you can't, don't do anything because the market is overshooting. None of the data that we've seen supports the depths of what's going on in these asset prices. So, don't panic, don't be emotional. None of that is helpful because the fact is that none of the gains to the upside, especially in the S&P, the US market was one of the most QE driven, insane responses that one has seen in asset markets in history over the last couple of years as it just relentlessly marched higher. Of course, no one was coming out then saying, wait, don't buy, don't hold. It looks crazy. The market is way overshot to the upside here. No, that's always considered reasonable and prudent to stay with it. But when things start to reflect reality and reprice lower, then all of a sudden everyone's accused of being emotional if they look to protect their downside or, protect themselves from losses. And the thing is, the losses take years to recover, right? Yeah. So in real terms, individuals are not institutions. I've been talking about this for 15 years. You can't theorize, and especially when they're in their 50s already, baby boomers, and people will talk about over 30 years this and over 30 years that. Right. There isn't anyone in their 50s that should be thinking about their money on a 30-year horizon. I mean, it's crazy. So so I actually have been encouraged by what's been going on in the last number of months. We're off to a good start in 2016 in the revelation about, where valuations are overdone and the downside. We've seen a lot of really productive progress in mean reversion on some of these really insanely valued assets, especially in Canada, especially in dividend paying sectors. Berkshire Hathaway is down more than 13%. I mean, these are the things that people think of as uber conservative, Kerry. And my point all along has been, these are the things that have become the most obscenely valued in this low rate environment where everyone was herded into, quote, dividend paying stuff and didn't pay attention to how insanely valued they'd become.
Yeah, well, dividend stocks for the past 6-7 years really could do no wrong. When there were market fluctuations, the dividend paying stocks stayed up, especially the master limited partnerships, mostly energy based in one form or another. Some of them are still holding up because even though energy is down, you still need pipelines, right, to ship the stuff. Those pipeline midstream MLPs have still held up somewhat. Everything's down, but they're not down as much. Uh, but the ones that relied upon cash flow from exploration and production have gotten decimated. But some of them also hedged as well, right? So
Well, really, what this cycle is about is debt and leverage. And the thing is that it isn't really helpful to say we're going to still need commodities in the future. We're going to still need oil. We're going to still need pipelines. All that's true, but that has very little to do with the valuations in financial markets. And the fact is that they are not, because everyone was so aggressive and confident in the upstroke and in the liquidity flying everywhere and people able to borrow money at ridiculously low rates. Even on the higher grade corporate bonds, spreads have widened out to 8% just in the last number of months. Whereas the triple C credits and less are, they've ballooned out 18%. Now we're starting to see some compensation for risk when you're being paid 18 and 20% and you're dealing with high risk paper. Okay, that's one thing. You can make an assessment about whether that's worth taking the risk with your capital. But in the suppression phase, all the yields were being pushed down and no one was being paid for risk. So what's really important, I think, right now is the knockoff effects that we're likely to see from the credit crunch that's hitting really just in a magnified way in this first quarter of 16, Kerry. From energy, but spreading into all the services that relate to energy, as well as the financial institutions that have loaned to this sector in a concentrated way in North America over the past few years. And especially since 2011, what people little understood was that, as the prices plunged in the Great Recession and then rebounded quickly on QE stimulus, people thought that was a sign that demand hadn't dropped, that demand was roaring back in the world. In fact, that wasn't the case. That was a financial re-engineering of the price. So people got the wrong signal from that, and they went back to pounding a bunch of capital into the energy sector and the commodity sector, which, in other words, they allowed them to borrow more and more and more. They were already too indebted from the boom phase, but they were allowed to borrow and take in more capital. Well, that was all malallocation and bad bets. And that now is having to be repriced lower. And as that happens this quarter in particular, I think you're going to see some sobering in equity prices, because the equity is going to be connected. It typically trades in correlation with the high yield debt market. And as you see these spreads blow out, you're likely to see equities continue to get under pressure and selling pressure as well. And also the buyback machine is broken now, right?
Oh, yeah.
So the big borrowing cheap to buy back your own shares or pay out dividends to placate investors, that machine is now broken because rates, as I said, have ballooned out so wide that it doesn't make any sense. Not only is cash flow decimated in this downturn with revenue prices falling and prices of commodities falling, but their borrowing costs have escalated at the same time. So they got the worst of both worlds really hitting at the moment.
Well, it's this goes back to one of my favorite economists in history, Ludwig von Mises. What you described is exactly what happens when you have artificially low rates. Businessmen are deceived. Business people are deceived by the numbers. They believe that all these projects become viable, which really aren't. And then you have inflation, which you had in the oil field, where the cost of drilling services, all sorts of services that you need, skyrocketed. And then all of a sudden prices went down. And if they had real interest rates they were dealing with, a lot of these projects would have never occurred. We wouldn't have this bust phase that we're having now. And it's all very predictable. It's the business cycle, right?
Yeah. And it's also magnified, as I said, because of record leverage and margin use and lending. So, escalator up and elevator down is how these leverage cycles work with asset prices. So you've got world cap that went up, about 70 or, about 30 trillion bucks between 11 and 14 has now come off another more than half that in just a matter of the last sort of 6 months. So that's sort of typical of how this works. It looks great, and it's sort of all, it was an insanely low amount of volatility on the way up because everyone became uber confident that the central banks had the back and everything was under control. And then the revelation hits that central banks are actually lost in the wilderness, have been playing a confidence game, have no actual tricks up their sleeve, and everyone starts to run for the hills at the same time. And that's why you get these abrupt move down. And you get, short covering rallies and intermediary, rallies. But in typical fashion, what we've seen is they've been sharp corrections higher, and then lasting a shorter duration each time before breaking to a lower low. So I think the U.S. market's got a lot of catching down to do here. The rest of the world has already, more than 40 markets are already off more than 20% around the world, Canada being one of them. But the U.S. market still has held up relatively well. And I think that is that gap, as earnings have contracted year over year, and they have, earnings for the S&P are off about 15% year over year. At that same time, the price of the stocks have not contracted enough, thanks to FANGs and certain ones holding the broad markets up. But that makes even greater price risk in the U.S. stocks today relative to some others.
Yeah. Oh, yeah, you're right. So, yeah, the worst is yet to come, as they used to say on Batman. But, hey, public banking, you've become a proponent of public banking. I guess you need to define exactly what public banking is.
Yeah, so it's not a new concept. It's been around for a long time in various places in the world and at various times. So in the 30s in Canada, for example, the Prime Minister and the cabinet at the time made an amendment to the Bank of Canada Act to say that for infrastructure spending that governments needed to do in municipalities and provinces, and even federally, that we should look to the Bank of Canada to be a public finance vehicle. In other words, have taxpayer dollars in the system allocated for specific infrastructure programs, which could then be paid back through taxpayer revenue interest-free over time. So obviously the idea being that we all have a vested interest in having a well-functioning infrastructure in the country, whether it be rails and highways or energy grids or water systems, all that. It is a huge backbone to support the economy and economic progress if you have a strong system. And so it made perfect sense that we would self-finance all that stuff. But what happened in the 80s was that became, the Bank of International Settlements, this cohort of banking executives who said, let's go around and tell governments about what benefits they can gain by allowing private banks to do this financing for them and not do it through their publicly, their public banks, but do it through private banks. And that was, the beginning of this massive episode we've had where banks have extracted great value out of everything in the world. So they are today, they've been issuing all the debt. Not only do they do the actual lending and collecting the interest for these projects, but they also do massive underwriting, which generates fees, right? They float these issues on the market. And so anyway, that has allowed interest on interest on interest to enslave people and countries and provinces. And it's opened, for a while, it seemed to be sustainable perhaps because, again, rates were falling from 1982. And so people could just borrow more to, backstop, to supplement income, take another line of credit to look like you were paying back the other money you've already borrowed.
Right.
But now that we're getting to the point where people are, and every level of government, companies, everything is so completely buried in debt. At the same time that you have a repricing of these assets lower so that rates are jumping higher, even though policymakers don't want rates to go higher. The reality is bonds are falling, credit risk is revealed, and all of a sudden the rate spread starts to go. So now we've got people with record debt, lower cash flow worldwide, slow growth world, demographics, all that. and people can't make the debt payments because of the interest component. So anyway, I think it's a time it's an idea that's been in the works. There's been a lot of people advancing it again, saying, hey, constitutional challenges like how did we get in this pattern of giving all these profits to private banks when we're not even supposed to be
good question
doing that. So you've got some constitutional challenges underway all over the world. You've also got actual governments making changes in many countries in the world, like legislative changes saying that they want to start cutting this private sector off and looking to public funding for these projects. So I say it's a perfect solution. It's an idea whose time is now, out of necessity, frankly, because we don't have enough money to pay for everything that people need to pay for to keep a civil society afloat.
Right.
We can't afford to give the gravy train to the bankers anymore.
No.
So I think it's a perfectly smart solution for everything that's gone on right now to help get us back on our stable fiscal footing.
Yeah, I agree. It's just who's going to run the bank. I think we run into the same problems that we have with underfunded pensions right now. Presumably, we'll have the state controller. We call them in the U.S. in many states. Sometimes they call them auditors. They have different names, but basically the state comptroller is generally responsible for investing and overseeing hundreds of billions of dollars in some cases. And then you wind up where politics enter in, where they pass laws and say, well, you got to fund startups in New York State, for instance, or things like that. And I guess for the state to have it, probably not a bad thing because they can't print money. For the federal government, I mean, I guess we kind of have this, except that rather than just print the money, what the Fed will do is they will sell a bond and then they'll give the money to the banks to buy the bond from them, right? I mean, and then we wind up where right now 70%, I heard by some estimates, is the amount of interest that's rolled into the federal deficit, the 19 trillion. 70% of that is interest. And you got to wonder if we hadn't been paying interest on that debt, because we're paying it to ourselves theoretically, although not really. But some of it does wind up back at the Treasury. The Federal Reserve's surplus for the year gets paid into the Treasury after the member banks get dividends. So you got to wonder if we hadn't been using this unsound model all this time, what the deficit would really be. It'd be much less than 70% less, because a lot of these bonds would have been paid off over time.
There's no question the compound impact of interest eats you alive after a certain point, and it's been a mammoth force in the debt that is enslaving the world. Now, it's not just that. It's not just the interest component, although that's a huge part of the bill today, but it's also the complexity and arm's lengthness of the model of, kind of pretending that you have money when you don't. So, for example, the more layers of this onion that one puts in, and that's what finance has done, is made this so complex that people can't follow the pea under the nut, and they never know where the nut is or where the pea is. It's just like, and that's the whole model, right? So, but this is something that wealthy people have done for years and years. And the way that many people become wealthy is that they self-finance their own projects, their own kids to get started, their own education. They don't borrow much from banks typically. And that's the dirty little secret. The way the finance world works for the average bear, let's say, is they pretend that they're giving you the inside scoop on, quote, how wealthy people get wealthy, but they are telling you the exact opposite of the truth. So in other words, they talk about borrowing to, buy everything, or borrowing for your education, keeping your mortgage because it's tax deductible, all these things. That is all nonsense. At the end of the day, if you can pay for stuff cash, you're going to have a much more savvy connection between your cash flow and your spending ability. You're much less likely to get confused or get ego driven about, having things that you don't actually have the money for. So the more you can have that connection between here's the designated funds and here's the project we're trying to fund with it, I think the less middlemen, the less subterfuge, the more accountable you're going to have the system and the less leakage. Another thing is currency exchange. Most financial institutions make the lion's share of their revenue from the complexity of currency exchange in the world. And a lot of people don't realize that. They buy things on their Visa denominated in another currency, and they're paying all these fees. Mm-hmm. So again, if you can go back to self-funding, it's a huge savings, and it's a huge traction that allows you to catapult ahead much faster in financial stability and strength than trying to use other people's money for everything. Even though the financial world tells everybody that the way to get wealthy is using other people's money, that's actually not true.
Yeah, well, obviously, for certain things, for productive assets, the less interest you pay, the better, the higher your profit. But, if it's an asset that you're going to buy that's going to yield income, then the debt's a little easier to justify. But for anything consumer goods, and I include that include houses in that as well, it's just a prescription to pay out a lot of interest and have a lot less money in the end. Unfortunately, I've learned that the hard way. And if I could go back and transport myself to my 21-year-old self, I'd be really doing well, a lot better right now than I am. But debt is a reason why debt's a 4-letter word. So public banking, something you should take a look at. You should also take a look at jugglingdynamite.com, Danielle's site, must reading. You've got Danielle's commentaries there and her market reports, as well as selected offerings from others, which, I think will stand you well. And as always, you'll find a link to Danielle's site in the show notes to this interview on financialsurvivalnetwork.com. And Danielle, be well. Did you get any snow? Did it make it to you?
We did, but it's melting now, so we're back in reprieve.
Yeah, my kids in New York City.
I think it's a bear market rally, though, for the winter. Yeah. In other words, you think you're losing the snow, it'll be back.
Yeah, but it's late. It's late in the day for your first major snowstorm. So, hey, winter's going to be over in a month and a half, right?
Yeah, oh yeah, it'll go fast.
Yeah, it'll go fast. And so will this bear market, rather, if you're prepared. But if you're not, it's going to seem like a lifetime. Danielle, we will talk to you in a couple weeks.
Okay, thanks, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.